2 days ago, one of the readers of my book sent me an email that hit me harder than most, and I couldn't stop thinking about it. Let me read it to you. I've been very careful with money my whole life, and I never wasted it. I always thought I was doing the responsible thing by saving money and keeping most of it safely in the bank. But now I'm looking around and I feel like I did everything right, and somehow I'm falling behind. And this really hit me hard. Because this is not just one person's story. This is the story of millions of people. People who worked hard, saved money, avoided stupid risks, and did everything society told them was responsible. They saved and they kept their money safe. At least this is what they thought. But in reality, many of them quietly lost a fortune without even realizing it. In this video, I will show you why one of the safest looking decisions in personal finance can quietly become one of the most expensive mistakes of your life. You'll see why cash is not as safe as it feels, why financially successful people think about money differently, and how they protect and grow their wealth. And once you understand this, you will never look at your bank account the same way again. Cash feels safe because the number in your bank account doesn't move. Basically, it behaves like a teenager when you ask them to clean their room. You put 100,000 in the bank, and then, after 10 years, it still says 100,000 plus maybe a bit of interest. There were no risk of crash, no scary red numbers, everything looks fine. But here is what actually happened. 10 years ago, that 100,000 could buy a certain house, a certain car, a certain lifestyle. Today, the same 100,000 buys much, much, much less. The house costs more, much more. The car costs more. Food costs more. Insurance costs more. A simple holiday costs more. Everything costs more. So you did not lose money in a way most people understand losing money. You did not invest badly. You did not gamble. You did not buy some crazy crypto coin named after a dog, or a president, or his wife. You just left your money somewhere safe. And while the numbers stayed the same, the value quietly went down. Over the last 10 years, cash has lost a big part of its buying power. Let me show you. This is the buying power of $100 over the last 100 years. And as you can see, it basically lost 96% of its value. So US dollar lost 96% of its value over the last 100 years. And if you take a look at a shorter time period, this is euro, so the buying power of 100 euros from 2016 till now, basically euro lost approximately 26% of its purchasing power. And these are just the official numbers. And if we go to check the US dollar in the last 10 years, it's minus 29%. So it lost almost 1/3 of its value officially. Okay, so these are just official numbers. They show the average price increase across a basket of basic goods and services, but real life is very different. For most families, the cost of housing, travel, cars, insurance, dining, and all the other everyday services went up much, much, much more. So while official numbers show a big loss of buying power, the real damage for many people was probably closer to 40 to 60% in the last decade. And for some families, especially those trying to buy a home, it was even worse. In the European Union, house prices went up over 65% over the last decade. And in the United States, house prices went up 83% in the last 10 years based on the National Case-Shiller Index. So, if you had 100,000 sitting in the bank, that money has lost more than half of its buying power. You did not see a crash. You did not get a warning. Your banker didn't call you and say, I need to inform you that your money is worth a bit less today. It happened silently. And that is the problem. The real question is not how much money do I have? The real question is what can this money buy? So why does this happen? The reason is that governments and central banks keep creating more and more money. More euros, more dollars, more pounds, more money entering the system year after year. And when there is more money chasing the same amount of goods, services, and assets, prices, of course, rise. This does not happen smoothly every year. Some years inflation is higher, some years lower, sometimes prices rise quickly, sometimes more slowly. But over decades, the direction is clear. There is more and more money in circulation, and when there is an abundance of something, it becomes less valuable. Let me give you a strange example. Lobsters are expensive today. You go to a nice restaurant, you order a lobster, and suddenly your credit card starts sweating. But a long time ago, lobsters were not luxury food. They were poor people's food. In some places, they were even used as fertilizer. Imagine that. Today we put lobster on a big white plate, add a little butter, charge 100 US dollars or euros, and call it fine dining. But back then, people looked at lobsters and thought, maybe this will help grow my potatoes. And the reason was that there were so many of them. Lobsters were everywhere. And when something is everywhere, people don't value it highly. But when something becomes rare, the price goes up. Money works in a similar way. If more and more money is created, each unit of money becomes less special. That is why over time you need more money to buy the same house, the same car, the same meal, or the same investment. And here is the important part. This new money does not just disappear. It flows into the economy. It flows into businesses, real estate, stocks, gold, and Bitcoin, and other assets. Money always looks for a home. And often that home is assets. So, if you are holding only cash, you are holding the one thing that is constantly being created. Meanwhile, financially successful people usually own things that cannot be created so easily. So what actually protects your wealth? And the simple answer is assets. Now, first thing you need to understand about assets is that there are two types of assets. Some assets are productive and other assets are scarce. And both can benefit when the amount of money in the world keeps growing. Now, not every asset goes up. Not every investment is good. And nothing goes up in a straight line. But over long periods, the best assets have historically protected wealth much better than cash. Let's start with productive assets like stocks. When you own stocks, you own real companies. You own real businesses. And these companies sell products and services. They can raise prices. They can grow profits. They can innovate, expand, and adapt. The stock market has survived wars, recessions, inflation, pandemics, political chaos, and many crashes. But over the long term, the direction has been up. Why? Because companies keep creating value. They sell more, they innovate, they raise prices, and the economy goes up. When you own stocks, you own part of the companies that benefit from growth, innovation, and higher prices. So this is an example of productive asset. Now let's take a look at scarce assets. Gold, for example, is valuable because it is scarce. Central banks cannot create gold with a keyboard. A government cannot wake up tomorrow and say, let's print another trillion million ounces of gold. Okay, this is why people have used gold as protection against money debasement for thousands of years. So, gold is not a productive asset like a business or a stock. It's a store of value. Why? Because it is rare, difficult to produce, and it is trusted around the world. Gold doesn't become better over time. The money used to buy gold becomes weaker and more abundant. Now, another scarce asset is Bitcoin. You can think of Bitcoin as digital gold for a new generation. Bitcoin creators simply took gold's strongest features, like scarcity and the fact that it cannot be printed, and then they improved some of gold's weaknesses. Gold is heavy, expensive to store, and hard to move across borders. Bitcoin is digital, it's easy and inexpensive to store, easier and cheaper to transfer, and dividable. Of course, Bitcoin is much more volatile than gold because it's a newer asset, but over its history, it has a very, very strong uptrend. So the basic idea is simple. Gold and Bitcoin are scarce assets in a world where paper money keeps being created. And this is what financially successful people understand. They do not keep most of their wealth in cash. Of course, they keep some cash, but they convert a large part of their money into assets. They own businesses, they own stocks, they own stock ETFs, they own real estate, some own gold, some own Bitcoin, and so on. They understand that the system rewards asset owners. They do not want to hold too much of a thing governments can create more of. They want to own things that are productive, scarce, or both. Now, if this kind of honest, no-nonsense investment content is useful to you, subscribe to the channel. I make videos like this every week to help you invest smarter and avoid costly mistakes. So subscribe now. But if all of this is so clear, why do so many people still keep too much money in cash? The answer is psychology. And it is more dangerous than any market crash. Money or cash gives people emotional comfort. The number does not move. There are no scary daily price changes, no red days. It feels calm and safe. But this comfort is very expensive. A stock market crash is loud. It is on every news channel. Your friends talk about it. Your portfolio shows red number. It's scary. But inflation is quiet. Nobody calls you to say, your money lost 3% of its buying power this year. There is no red number in your bank account. There is no dramatic headline. It just happens. Slowly, quietly, year after year. One day you realize your money can buy only half of the things it used to. And that is exactly why inflation is so dangerous for many people. They are afraid of the risk they can see while ignoring the risk that quietly destroys them. Most people think that risk is the market volatility when you invest your money. But real risk is bigger than that. Real risk is missing decades of growth because you are afraid of a temporary crash or correction. Real risk is retiring and realizing your careful savings are not enough. And this is the great irony. The people who are making the safest decisions are taking the biggest long-term risk. And the people who own assets that constantly move up and down are the ones who are actually better protected. Now, if someone you know is keeping most of their savings in cash because they think it's safe, share this video with them. It could completely change how they think about money. So click pause and share this video. The next time you say, I don't invest because I don't want to take risks with my money, ask yourself, isn't keeping money in the bank riskier in the long run? Because you can be pretty sure it will lose half of its value in 10 years' time. You may be avoiding short-term market risk, but you are accepting a big long-term inflation risk. And the longer you wait, the wider the gap becomes between what you have and what you could have had. Now, if you are watching this and thinking, okay, Robert, I understand the problem, but what do I actually do about it? How do I start? What should I invest in? How much should I have in stocks? What about gold? What about Bitcoin? What about the fees? How to minimize fees? And that is exactly what I cover in my free 90-minute masterclass. I will show you the complete system. How to build a portfolio, how to protect yourself against inflation, how to set up a plan that works whether the markets are up, down, or sideways. The link is in the description. So check out the description and click on the link there. Now, if this video helped you see your money differently, click the like button and subscribe. I make videos every week for busy professionals who want their money to work for them hard, without short-term trading and Wall Street nonsense. See you in the next video.